Hi everyone, my name is Anne McCabe. I'm one of the managing directors of Curo Private Wealth. It's almost June 2022, and needless to say, it's been a very challenging year, both in the stock as well as the bond markets. And so before we talk about where we are and where we may be going in the future, I thought it would be helpful to set the context to talk about what the environment was like coming into 2022. So if you look at the returns in the S&P 500, the 3 years leading up to the end of 2021, the S&P returned an average of 24% per year, which we know is much higher than the long-term average of about 10%. So it's to be expected coming into 2022 that we were probably going to give back some of those extra returns that we've experienced over the past few years. So we're experiencing a lot of challenges right now, and some of those challenges we were expecting and some we weren't. So let's talk about first the ones that we were expecting. First of all, inflation. We knew that inflation was an issue coming into the beginning of this year, and unlike what the Fed originally, or the Federal Reserve originally told us, that inflation was going to be transitory, it looks like inflation is much more sticky and much more of a long-term problem than we originally thought. As a result of that, we knew that the Fed was going to be forced to increase interest rates to try to put a damper on that demand and really try to bring inflation down. We also know that the stock market does not like when interest rates come up. The market loves easy money, loves low interest rates, and so it's typical that the market has a little bit of a temper tantrum around the first rate hike, which is definitely what we saw this year. The third thing we knew was that this year is a midterm election year in the US. We know that the markets do not like uncertainty, and midterm elections represent uncertainty. In fact, if you look at the average decline in the S&P 500 in a normal year, it's about 14%. If you look at that same calculation in a midterm election year, it increases up to 17%. So we know that volatility is higher in midterm election years. Here are a couple things we didn't know was going to happen. We obviously did not know in February about the horrific invasion of Ukraine by Russia. How that's showing up here from an economic standpoint is in higher gas prices at the pump, as well as higher prices on food at stores. The other thing we didn't know was that there was going to be a resurgence in COVID cases in China, and that China was going to reinforce its zero COVID policy, which means it's shutting down large cities, and that's putting more pressure on the supply chain that was already a challenge that we've been dealing with over the past couple of years. So we've talked about inflation, interest rates, COVID and the shutdown, midterm elections, and the Fed. The other thing that is a hot topic to talk about right now is the question of a recession. Are we going to have a recession this year? Are we going to have a recession next year? I'm not here to tell you I have a crystal ball and I can answer that question. We do still think the probability of recession this year remains quite low, but here's the good news. Even if we did have a recession, or we eventually do, which we know we will just because of economic cycles, that does not mean that we should be massively changing our investment management. So here are a couple things that you can do though proactively as a result of the situation that we're in. Number one, think about investment in asset classes that tend to do well in high inflation areas and high inflation environments. Real estate tends to do really well when inflation is high, commodities, and then good old-fashioned high dividend paying stocks. The second thing we can do is a strategy called tax loss harvesting. If you have losses in your portfolio that are unrealized, consider selling those positions, locking in the losses for tax purposes, and then turn right around and reinvest those proceeds into investments that are similar to your original investment. Now note, this only really works in non-retirement accounts, and as always with any tax advice, we want to make sure that you speak with your tax professional before you decide to implement any of these strategies. And the last piece of advice I can give you is, if you are a long-term investor and you have cash sitting on the sidelines, it may be a good time to consider putting that to work. I'm not sure you'll be happy with that decision in a year, but we're pretty confident that at the levels that the S&P is trading at right now, that you will be happy with that decision possibly in somewhere between 3 to 5 years. So if you're a long-term investor, take advantage of the sale in the S&P 500. As of last Friday, S&P was down almost 20%, so that could be a good potential opportunity for you to take advantage of. Thank you so much for taking the time to watch this. As always, if you have any questions, please feel free to reach out. Take care.